heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, full coverage on the inflation print. CPI coming in hotter than expected. Former U.S. Treasury Secretary and, of course, OpenAI board member Larry Summers joins to discuss.
Plus, TSMC sales surge after riding the AI chip boom. We'll break down the details and discuss Intel's unveil of its new Gaudi 3 processor.
And SpaceX's prized Starlink satellite business, but still burning through more cash than it brings in. We'll bring you our exclusive Bloomberg reporting and so much more throughout this hour. But first, it is a macro day. And the market is under pressure as once again pricing increases are still running a little hotter than the market wants to see. 0.4% month-on-month increase in consumer price index, higher than had been anticipated. And indeed, does the Federal Reserve therefore only get to hike, 2 times this year? The market and indeed the Fed had signaled 3 times previously. We reprice the idea that Fed hikes will be coming and only two of them. We're seeing a 1% fall on the Nasdaq more broadly. We're off of our lows, and indeed we are seeing a real pushback in terms of the bond market. We're seeing yields spiking some 18 basis points on the front end on the 2-year, but we're higher across the curve, Ed. Notably, though, we are down from those 21 basis point move that we saw a little bit earlier, but nevertheless, we are basically at the highs of this year. I'm looking at a Bloomberg dollar index that strengthens into a far more hawkish tone that's coming really from the market, signaling that the Fed doesn't and can't hike as many times as can indeed cut as many times had been anticipated. We're currently up some 0.7%, as many feel that perhaps we have to remain higher for longer. So fewer rate cuts coming. Will it only be 2 that we get for the rest of the year? Let's move on and have a look at what's happening in the price of Bitcoin, because as we see a more hawkish tone, yes, we're going to see risk assets sell across the board. We're down some 0.7% on Bitcoin as the dollar does indeed strengthen. But Ed, as we reprice what the Federal Reserve has to do and indeed maybe remain higher for longer, what are you watching on the micro?
Well, 3 semiconductor-related names that I would say are probably standing on their own 2 feet in this session rather than being caught up in what's happening with the post-CPI trade. Meta is actually basically flat, a 10% higher. Next generation of its Meta training and inference accelerator, its own AI chip that will now be deployed, just been announced. Not doing much for the stock. Intel's down 2.3%. Gaudi 3 AI accelerator is coming in the 3rd quarter. Intel's saying that it outperforms in some training cases NVIDIA's H100 and will be comparable to the H200. That stock's down 2.3% though. And Taiwan Semiconductor, these are the US listed shares or ADRs, they're up 1%. The March quarter saw sales jump a better than expected 16%. That's the best jumping growth going back to 2022. And the story, as we said at the top of the show, is TSMC riding the AI wave. Remember, this is the world's biggest contract manufacturer of semiconductors.
Yeah, let's dig into TSMC and chips more broadly. We're pleased to welcome Bloomberg's Ian King. And, well, it was a surprise, but we perhaps were anticipating a real strengthening of TSMC's business because of AI.
Yeah, I mean, all roads lead to Taiwan right now. If you're going to build anything, whether it's NVIDIA and their data center accelerators, whether it's AMD, who are doing better in servers than Intel, who are also getting into data center accelerators, whether it's Broadcom and the networking, you are going to TSMC and you are paying for their most expensive stuff.
That is pretty much a shape of the industry kind of story. There are some specific names that are interesting. Meta is interesting, a story you've been writing about with Asia Counts. We've just broken the story that they're bringing a next-gen MTIA chip, but this is the in-house silicon they want to deploy for their own training and inference purposes. What do you make of it?
I mean, this is them basically joining that long list and lengthening list of these companies that think, hey, I can do this better in terms of what I can...
Better than who?
Well, that's the problem, isn't it, right? They don't want to be paying the massive premiums that they're paying to NVIDIA, but they still are. But when it comes to a general purpose processor like this one, perhaps we can do it better than Intel.
Isn't it fascinating that we see this after the day after the cloud event coming from Alphabet, where there is just this ongoing tension of these big providers of cloud, but also runners of AI and builders of large language models, wanting to depend on NVIDIA, but not too much, and ultimately having to be frenemies. Ian, is this a relationship that can continue?
I mean, it's been going on for years now. If you look at AWS is the progenitor of this trend, and they have really shown that, look, we can, we've got the size to make the economics work, so we will do this as much as we can. But at the same time, the real silicon companies that have been around for years are still just about in the lead. They're still able to push the performance to the limit. So that's the balance that's been struck.
Let's end on Intel. Intel has introduced its latest AI accelerator, Gaudi 3. It will be available in the third quarter of this year, but likely not at scale. And its performance is where Pat Gelsinger has focused. What else do we need to know about Gaudi 3?
Well, it's not so much about Gaudi 3, really. It's the elephant in the room, which is what NVIDIA announced earlier this year, which is they'll have their new Blackwell architecture in the market probably around that time. And as Gelsinger was forced to basically admit yesterday, we don't know how we'll compare to that. And the inference that people have taken from that is you won't be able to compare to that.
All right, Bloomberg's Ian King, who leads our semiconductor coverage here at Bloomberg, and he's a very busy man. Now, coming up on the show, we break down today's CPI report with former US Treasury Secretary and OpenAI board member Larry Summers. It's coming up. Stay tuned. We'll be right back. This is Bloomberg. Coinbase and Circle have penned letters to Senators Schumer and McConnell urging Congress to enact a comprehensive regulatory framework for stablecoins and digital asset market structure. It comes a week after US Appeals Court revived a 2021 consumer lawsuit against Coinbase, accusing the cryptocurrency exchange of facilitating the sale of unregistered securities. Joining us now is Faryar Shirzad, Chief Policy Officer at Coinbase, on set in San Francisco. Let's start with the suit, or the revival of the suit last week, and just get your immediate response to it.
Well, the suit you're talking about is a private action that has gone up to appeals and will go back to the trial court. We did quite well at the trial level. There were a couple of issues the appellate court has sent back, and so we look forward to going back to the district court and settling those out. But the big issue is the litigation involving the SEC, and we feel quite good about where we are. We were able to get one of the major pillars of the SEC's case against us knocked out at a very early stage in the trial. We're going to go to discovery,
yes,
and we look forward to that process.
We're going to talk about your relationship with DC and the regulatory pathway, but one thing we've reflected on Bloomberg Technology in the last year is that in your industry, we continue to regulate through lawsuits.
Yeah.
Would you say that that's a fair statement? And in the context of both the consumer suit and the SEC, that's what's happening still?
Oh, absolutely. I mean, in the end of the day, as a company, our goal is to get regulatory clarity. So if that's through lawsuits or otherwise, we'll take it. But the right way to regulate, particularly if the U.S. is going to be a leader in digital asset technology, is for Congress and the administration to do what they say they want to do, which is to create comprehensive federal frameworks around crypto markets and around stablecoin issuance. I think we can do it on a bipartisan basis, and we hope our letter is encouraging of that to happen.
You've written this letter to Schumer and others, McConnell and others. Why?
Well, we have a shared objective with Treasury and law enforcement, which is to get at bad actors that are in the crypto space. So there are specific powers that Treasury should have. They've asked Congress for, and we're supportive of. But we also want to remind everyone that the big picture is that we need the industry to grow in the United States, reflecting U.S. values and under U.S. laws. And the bigger the U.S. industry is, and the more comprehensive it is in terms of defining crypto globally, the better it is for American national security.
What the lawsuits we discussed and this initiative with DC have in common is you're trying to make everyone feel better that the ghosts of your industry are behind you. Let's be honest, Sam Bankman-Fried was a big story of the last week, his sentencing. Do you feel like, that's your job, are you making any progress in convincing a wide range of people that this is a cleaner industry that is making progress?
Well, absolutely. I remember much of the bad actions that we saw, FTX, Binance, others, were largely offshore. So I think for a lot of people, it surprises them the degree to which there is a dividing line between the U.S. industry and those offshore who avoid stringent regulation. But in the end of the day, 52 million Americans who have bought crypto. The American people have voted with their feet and their pocketbooks that they want to help update the system by participating in the crypto economy, and regulations need to keep up with them. And I think there's a bit of a gap, but sometimes between policymakers and the public. And I think once people begin to see how many Americans have participated, I think they'll understand stuff.
We've carried some committee hearings on this program, and we were aware of some lawmakers' thoughts on your industry. If there is one area of lingering concern, it's about the use of crypto, which is a broad term now, in illicit finance or white collar crime. How much progress are you making with getting DC on board to work together on that front?
Well, I think Deputy Secretary Adeyemo said it well, that the traditional financial sector is by far the larger threat to illicit activity. That's where most of the illicit activity occurs. I think they look at crypto as an area of potential future emergence as a center of illicit activity. Any amount of bad actions in crypto is too much. Companies like ours follow all the same rules that traditional finance does. Our Bank Secrecy Act regulated and so on. And so I think those who know that the industry in the U.S. is a good actor.
It's clear what you want, but we have this House Financial Services Committee piece of legislation that Patrick McHenry is trying to get through. No traction there. Why is there no traction, really?
Look, it's rare for Congress to pass bills through two different committees with strong bipartisan votes, and that's what we have. So, yeah, I think, getting any legislation done, funding the government, funding the wars, all of that's going to be hard to do. But if you take a step back and realize that you've got Democrats and Republicans who've come together, who understand we need digital assets in the United States, and they voted for it, I think that's exciting.
Faryar Shirzad, Chief Policy Officer over at Coinbase. Great discussion here in San Francisco this morning. Caroline.
Yeah, we've got to turn our attention back to the macro picture right now. That CPI print, hotter than expected. Third straight time that inflationary pressures are coming in faster than expected. Month-on-month increase of 0.4%. Now, this is affecting the market. Check out where we're currently seeing bond markets. Yields the highest so far this year. Yields up, significantly higher when you're looking at a 2-year yield, some 18 basis points. Some of the key outperformers, Meta still manages to outperform on the day on its AI news. Intel, though, dragged lower as we see chip makers more broadly sinking. But I'm looking at the moment, Bloomberg Dollar Index currently up some 0.8%. Now, this is as we see the Bloomberg Dollar Index actually at its highest since November of last year. So dollar highest since we've seen this year. Yields highest since we've seen this year. NASDAQ currently off by more than a percentage point, but put it into context, we're still near the highest for equity benchmarks that we've seen on record. But what is the takeaway on the CPI print? What does the Fed do in terms of rate cuts? Is June off the table? So much more to discuss next with David.
For our Bloomberg audiences worldwide, I'm David Weston. We're joined right now by Larry Summers of Harvard, a very special contributor here on Wall Street Week. So, Larry, great to have you with us on short notice. We've been talking about inflation on Wall Street Week for some time now. I know you're not hoping for more inflation, but you've been warning about it. What do you make of the numbers we saw today?
I was not hugely surprised by the numbers. In an economy that's growing faster than potential, with an unemployment rate that has a 3 handle, in the presence of massive and growing budget deficits and epically easy financial conditions, the idea that inflation would remain robust or even accelerate should not be a surprise to anyone. And that's what this data suggests. It was not me or some outside observer who emphasized the concept of supercore inflation, that is taking out the transitory stuff and also taking out housing. And by that measure, inflation is running at above a 6% rate, and the 3-month rate exceeds the 6-month rate, and the 6-month rate exceeds the 1-year rate. This confirms the idea that the neutral rate is way above the 2.6% level that the Fed has been using as a North Star, in my view, puts back on the table. It is still not what I would expect, but you have to take seriously the possibility that the next rate move will be upwards rather than downwards. And anything could happen. Markets could crash, the indicators could turn down. But on current facts, a rate cut in June, it seems to me, would be a dangerous and egregious error comparable to the errors the Fed was making in the summer of 2021 when it just didn't get the thread on inflation.
Larry, you mentioned the supercore that, as I recall, Chair Jay Powell, among others, has talked about specifically. It raises the issue of, are there aberrations you see in these data? We hear some people saying, wait a second, this is really housing and auto insurance. There are a couple of outliers, and that the rest isn't as troublesome. Is that right?
I don't think so. Look, you can always find particular indicators that are up or down, but when you're making up a story month after month, that's a problem. When commodity prices are spiking and those are being taken as a market indicator of inflation expectations, when break-evens have risen, when the political economy of the country is heavily about inflation, trying to dismiss it on an indicator-by-indicator basis is an odd thing to do. Look, it is a technical subject, the price indices for housing. I don't think there are many Americans who feel like housing is becoming lots more affordable these days. They really don't. And so to argue that somehow housing isn't a source of inflation psychology seems to me to be quite a surprising view to take. Look, why are we thinking about rate cuts when the economy is below what the Fed thinks is the normal unemployment rate, when the economy is growing faster than what the Fed thinks is potential, and when inflation is unambiguously above target and plausibly accelerating? The Fed has once again, in important respects, lost its way over the last 6 or 9 months in the same way, making policy and making forecasts based on hope rather than on a hard-headed look at reality. I think that the Fed did a good job of cleaning up on the errors they had made in 2021. And I think it's reasonable to think that they will pivot off the errors they made last fall that led markets to be ludicrously expecting 6 cuts this year. And I'm hopeful that that will happen. But I think the Fed does need to learn some important lessons from this experience. Let me say one other thing, if I could, David. There's been a lot of talk about 1995 as some kind of useful analogy. I think not. The unemployment rate was 5.6% in 1995. Equity markets, as shown by the fact that they more than doubled subsequently, were not frothy, particularly in 1995. We had just come off a major program of deficit reduction rather than being in a program of unprecedented fiscal expansion. And we had really clear evidence of a kind we don't yet have now of productivity acceleration. And interest rates were higher than they are right now. So the case that somehow this moment looks like 1995 and that's a reason for cutting is something that I find inexplicable. Yeah. Another thing that it seems to me is problematic is the notions that are increasingly being bruited about that the Fed is going to slow QT. Of course, one of the things that today's movement in interest rates, the interest rates moves that we've seen over the last month mean is that the Fed's efforts to do carry trades in the bond market have proven to be extremely expensive for taxpayers, and the length of time for which the Fed is going to be showing annual losses or on a mark-to-market basis, large balance sheet losses, that looks like it's longer than we thought some months ago. So we need a Fed that stays focused on what is very clearly the focus of the American people, which is price stability. And I'm afraid there are some signs that in the last few months they have lost their focus in favor of more ambitious economic theories about preempting slack that's not happening or some such.
Larry, you're always the first to warn us that things can change, so we can't predict what's going to happen in the fall and into next year. You've said you think it's definitely a mistake for the Fed to cut in June. But given where we are right now, what you know right now, if you had to make a decision, are we going to see any cuts this year? And what is the likelihood of actually an increase?
Just to quibble with what you said, I said on current facts, I see no case for a cut in June, but facts can change. Inflation indicators could come in much lower than most of us are expecting. The economy could turn down. So never make an absolute judgment about policy several months from now, because all kinds of surprises could happen. I think the odds are that the next rate cut will be down rather than up. But I think you have to assign a greater probability to the next rate move being up than you did several months ago. I don't know whether it's 15% or it's 25%, but somewhere in that range is what I would say for the next rate being up. I still think the odds probably favor another rate cut this year, but not by very much, and not by as much as is priced into the markets, even after the adjustment that we have seen. So reality, markets are adjusting to reality. The Fed is adjusting to reality, but I think the process is slower than would be ideal.
Larry, let me ask what for some of us might be the scary question, which is, does the Fed have the power to get their arms around inflation at this point through monetary policy, or are there other factors that are larger than what they can really affect over the short or medium term?
I think the Fed has considerable influence over inflation expectations, which are an important determinant of subsequent inflation. I think monetary restraint does influence the economy, which feeds through into the inflation process. But gosh, we ought to be doing everything we can on the supply side. Anytime anybody sees a bottleneck, we ought to be going after it. I am all for effective competition policy that restrains price increases. I think the most important competition policy is maintaining economic openness and allowing competition for U.S. goods from less expensive foreign goods. That's the most important competition policy. That's the most important anti-gouging policy. That's the most important contain excessive profit margins policy. And so I'm sorry to see the extent of bipartisan consensus in favor of policies that are relatively protectionist. Do people really think there is an overwhelming danger that we're going to have excessive production of batteries in the world, given climate change? Do people really think there's an overwhelming danger that we're going to have an excessive effort to use solar power? If not, I worry in inflationary times about policymakers decrying the growth of capacity. And there's been a certain amount of that on Secretary Yellen's trip to China and in U.S. rhetoric on a bipartisan basis. So yes, we should complement the Fed with fiscal policies that are oriented towards restoring credibility, recognizing the defense spending that's going to need to come and allowing for it, and with microeconomic policies that are competition promoting, the most important of which is openness to the global economy with respect to goods, with respect to labor, with respect to the flow of capital.
So, Larry, you mentioned 1995 and productivity. Is there some hope, perhaps, that we can get some relief from inflation because of generative AI? You're on the board of OpenAI. We had Jamie Dimon this week come out with his letter saying it's like a steam engine. You at one point, I think, said it was like fire. Is there a prospect that we could get some downside risk, as it were, to inflation from generative AI?
I think it's a question about horizons, David. And again, I never make completely confident predictions because the one thing we know about the economy is that it surprises us. I think that's potentially a very important factor if you look 3 or 4 years out. I would be very surprised if it was an important factor in the next year or two. And I think the fact that artificial intelligence is a potential competitor for commentators leads this to kind of have more salience in commentary than it otherwise would. So yes, for the long run, I think this could be a huge event for inflation, a huge event for productivity growth. But I'd be pretty surprised if the effects were really large in the short run.
And I thank you for mentioning commentators and not interviewers. In that sense, I really appreciate that. One last question. It's important to Bloomberg audiences in particular. Financial conditions. You referred to the signaling of cuts last fall. Financial conditions have been sort of off to the races here. To what extent do you think financial conditions played a significant role in these numbers we got today?
Well, I think there's no question that the $12 trillion of wealth that have been created have contributed to greater spending, which has contributed to inflationary pressure. I think the availability of credit has had similar kinds of effects. So I think it's hard to quantify precisely, but I think there's no question that financial conditions have had a role. But look, David, sometimes the different indicators are pointing in different directions. This time, activity is super fast. Unemployment is very low. Fiscal is highly expansionary. Financial conditions are very loose. And on-the-ground inflation measures are above target and possibly accelerating. What is the theory of a rate cut into that configuration? right now. I don't think there is one. And I think that the Fed has a communication challenge in keeping it on the table because, again, anything can happen. There can be financial accidents. There can be sudden changes towards reduced employment. There can be global developments. So never rule anything out. But I think there is a communication challenge around the fact that in the mainstream scenario, we do not need rate cuts right now.
Larry, thank you so much for taking time out of a busy day to spend this day. That's Larry Summers of Harvard. And now back to you.
All right, thanks to David Weston and Larry Summers. Let's get a quick check-in on the markets. NASDAQ 100 is where I'm looking because throughout the course of that interview, we actually paired declines on the NASDAQ 100 from a session low of 1.3% to around 1%. We were treading water at the start of this week until we got that hot CPI print. Not seeing any movement, at least at the short end of the curve in the bond market, but CPI front and center. In terms of the news cycle, we continue to look at individual names. AI and the impact of infrastructure build out, which Larry Summers was talking about a little bit there, continue to be stories. In terms of the individual names that we're looking at, three kind of main stories in the chip space today. If the director switches up the board and we get to them, thank you very much. Alphabet shares down 1%. They held their Google Cloud Next event where they basically demonstrated that Gemini Pro 1.5 generation model is ready for the enterprise use case, and we dug into that throughout the show. Intel continues to be lower, 2.4%. Gaudi 3 coming in the third quarter, the market's not cheering it much, and Meta up 0.5 percentage point. Introducing their own AI accelerator, or the current generation they're starting to deploy, that share has pushed higher since that news came out. Those are the public markets. Let's talk a little bit about the private markets. SpaceX's prized Starlink satellite business is still burning through a lot of cash. Sources familiar with the finances of the world's most valuable startup say that Starlink has lost at times as much as $450 on each of the millions of ground terminals that it ships. And that's cast some doubt on claims by CEO Elon Musk and the company's top brass that the business is in, quote, profitable trajectory. But could Starlink be turning a corner, Kara?
Well, this is where I ask you for your expertise on this. The joy of being a privately held company is you don't have to be making public statements about your finances, but people are interested because this is a company that probably has to raise money in the private field. So ultimately, what is revenue doing at the same time as profitability is still not quite there?
Yes. So we know that this year is a key year where revenue from Starlink, constellation-based internet, outpaces the launch business. But I think what sources are telling us is that SpaceX can be quite selective in the financials it puts forward when they do a funding round or investors ask. The main thing is that they've zeroed in on manufacturing, just like Tesla did, to improve the manufacturing process for both the satellites themselves and the ground receivers. Now the margins on Starlink are improving. And what I heard from sources is that at the end of 2023, they kind of hit this profitable metric, and that's continued in a more meaningful way into 2024.
And it is notable that I think it's a great story that you've written with colleagues, Carl Porter, Lauren Gush as well. But really the CFO isn't hinting that there's going to be an IPO anytime soon. But you want to be seeing ultimately when Starlink is such a linchpin for SpaceX in terms of, well, they're thinking of what's separating it off as a business.
Yeah, the simple equation is this. The launch and Starlink units need to be profitable, and that profit will fund development of Starship, and Starship will get humankind to Mars. Let's keep the conversation going. Joining us now for more is Andrea Lamari, a managing partner at Quattro Capital, but also transitioning general partner at Manhattan Venture Partners. That's a venture firm that is invested in SpaceX across multiple funds under their management. You have invested in, tracked this company for a long time. How zeroed in are you on Starlink and Starlink's profitability?
Thank you, Ed and team. So I would say overall, as we look at SpaceX, valued at north of $180 billion at this point in time, and has deployed 5,600 active satellites, which is just tremendous. So obviously below the signaled target of tens of thousands of satellites that they've said that they can achieve. Overall, what we have said is that profitability margin can increase, but the money that they spend manufacturing the satellites and spending money on ground terminals has to continue decreasing. And with that being said, we know that Starlink will always be this amazing harbinger for all the missions and launches that they're doing. And we saw this week that SpaceX continues to build great momentum with some of their customers with their bandwagon test flights. And, they are intending to send payloads to Earth with all of their customers. But with Starlink, they have to really build that customer trust and momentum and continue reducing latency. Otherwise, there is a world where they do see that consumer trust diminish.
And what about trust of you, the people writing the checks? I'm really interested as to when you've been writing checks at the very beginning of such a business, it was all about just making the vision a reality, let alone thinking about profitability. But when we start to see the nuances, profitable territory, does it worry you when actually perhaps some of the here and the now isn't living up to those sorts of statements?
I would say that overall, there's been tremendous gains happening at SpaceX for what they've achieved in such a short period of time. We have a lot of trust in SpaceX because, Elon at the helm has always been known to make boisterous statements around the nature of the profitability and growth of his companies. But the proven momentum in the trust that we have is shown by way of the various components of customers across all of SpaceX's lines of business. And with that being said, with Starlink, we have to see that they continue expanding their coverage. As we know, there's a lot of entrants coming into this space. See what Amazon is doing with their Kuiper project, for example, right? Of course, on a much smaller scale, and there's going to be a lot of work done that took SpaceX quite a long time to get to the point where it is with its Starlink deployment. But overall, I would say SpaceX has such a leg up against its competition, both domestic and international, and it's really with Elon at the helm.
Or indeed, it's Gwynne Shotwell as well, who's really sort of operating at this business, the SpaceX president. She had a great line on a podcast recently saying there's probably 150 rocket customers out there on the planet, but there's actually 8 billion potential customers of Starlink. What does Starlink need to do, not only in terms of revenue and profitability, but actually just ease of use and reliability to make sure that we start to see more than the current user base?
So overall, they have to continue optimizing satellite positioning with that reliability. They have to improve their ground infrastructure. They have to address those technical issues promptly and be reliable with their customer service. I do say that Amazon, overall has had a tremendous customer service arm. And as the Kuiper project comes in as a new entrant in this space, overall, we have to see that SpaceX can keep up with that reliability. And furthermore, with Starlink, they have to continue expanding coverage. It involves targeting specific regions that still have satellite deployments that are necessary and marketing those efforts to potential subscribers. And we know that as Amazon continues to encroach in this space, they have a captive audience of potential customers, which will mean increasing competition across the board.
Andrea, SpaceX is a fantastic company. The Starlink technology we've just discussed endlessly, and the financials are what they are. They will be profitable, they won't be, and we will get humankind to Mars on Starship maybe. But you're an investor in SpaceX, or Manhattan Venture Partners is. There's intense interest. How difficult is it to get hold of SpaceX and say, I want to invest in your company? What is the competition like to have a piece of that pie?
So it's a fantastic question, Ed. I would say it's a very competitive cap table, right? The equity ledger of SpaceX and getting involved as an investor. You have to prove to be a value-add investor and be willing to stay with the company for a long duration overall. And with that being said, because of the enormous amount of capital and the billions that SpaceX has raised to date, you have to prove that if you want to be an investor in SpaceX, you're willing to also deploy quite a large check as a private market investor. And so with that being said, SpaceX has been quite selective, and you will see that the newer investors that have joined the cap table are ones that can really weigh into the company now with a large check be value add, and then most likely be the same investors who will anchor the company going into the IPO and then continue investing once the company goes public, if and when that happens.
Quattro Capital Managing Partner Andrea Lamari, great to catch up, great to talk SpaceX. Thank you. Toyota Ventures has just raised an additional $300 million for its venture fund, $150 million for its Frontier Fund 2, and $150 million for its Climate Fund 2. Joining us now to discuss where they'll be investing is the founder and general partner of Toyota Ventures, Jim Adler. And yes, Toyota Ventures is the early stage venture capital arm of Toyota, which has $800 million in assets under management. I know Toyota. Been talking a lot about Toyota for the last year in the context of EV or no EV. This is more money for you to play with. How involved is the mothership in Japan in each investment opportunity that you look at?
Well, thanks for having me, Ed, Caroline. I think that our mission is to discover what's next for Toyota. So there is a bit of a decoupling between what the corporate parent is doing. We view Toyota as our limited partner. We are a venture capital fund, and the startup is our customer. And so there is, I think, a healthy decoupling between what we're doing, which is investing for the very long term. The good news for us is that we have a very engaged, thoughtful, patient limited partner in Toyota, and they have continued to support us and our connection with the startups that are bringing the disruptive innovation to the marketplace.
A lot of the legacy OEMs have a venture arm, works in a very similar way, and they're looking for something that adds in some way. But within that is a huge range. Software, battery technology. Toyota's still very much focused on hydrogen, as I understand it. Just outline where you'll be looking.
So we, as you mentioned, we have two funds, a Frontier Fund, which is focused on AI, of course, autonomy, mobility, robotics, a little fintech, and then our Climate Fund, which is focused on carbon capture and storage, renewable energy, battery electric, hydrogen, as you mentioned, and even far-reaching technologies like nuclear fusion. So we are really discovering what's next for Toyota and looking in places that are often not looked at by a big Fortune Global 100 company.
A lot of robotics in there when I'm looking at portfolio companies, 75 global startups already, Jim. What about exits? You've had one, Joby in particular was a high point, I'm sure. Are you anticipating that you're going to be able to reap some rewards from prior investments this year?
Well, Caroline, we do operate like an institutional venture capital fund, so financial returns are important. We are structured along a decade-long GPLP term, so we do expect to see financial returns along the way. We are patient. We work with our startups every day to see them come up with their innovations, bring them to market, grow their valuations, and ultimately end in an exit that works for them, the other investors, and of course us as we count ourselves among our co-investors.
How competitive is out there at the moment in the VC space, Jim, briefly?
It depends on the sector, of course. We tend to like to hit them where they ain't. We look at into deep tech and places where we think the world is going. Because we are so patient, we can actually look in places that are deep tech, that are not necessarily running your typical SaaS valuation ramp, but might be popping, being very flat, and then popping in valuation as huge milestones are hit. In certain areas like AI, of course, things are quite competitive.
You started your career as a rocket engineer. Fascinating to see how you've now built into the VC arena with Toyota Ventures. Jim Adler, we thank you so much for your time. Christie's Ventures has now reached 10 investments since its launch back in July of 2022 by adding 2 new companies to its portfolio, Conserve and Mintage. We're here now with none other than Christie's Ventures Global Head, Devang Thacker, along with Vintage founder Nick Adler. And this is what's so interesting. You're investing in areas where sort of art meets technology, but also where fashion meets technology. Talk us a little bit about some of these investment rounds and how competitive it is in your space at the moment, Devang.
Thank you again, Caroline, for having us. Always a pleasure to talk here. 10 investments for us is a milestone, but as you know, we invest in 4 areas of technology, starting with fintech, because while people think things like buy now, pay later are a huge investment, we've been doing that for 257 years as a art company. Web3, which is something we started pioneering in digital art 2 years ago. AI more recently, and finally what I'm calling human-computer interfaces or hardware, because I think while chips at a macro layer are quite interesting, and we talk about NVIDIA, chips also connect people in very interesting ways. Mintage is one example here today, so is Conserve. Conserve works with institutions like MoMA and the Smithsonian libraries and archives to put chips behind paintings to track how their conservation is progressing. Are they having some sort of humidity? Are they sort of having some cracks develop? Like all those things are important in chips. We don't think about in those fashions, but chips are a very interesting human-computer interface. So that's an interesting area for us to invest in.
Talk about NFC chips in your vintage collection.
Yeah.
Why, Nick? What does it bring?
Well, vintage is an incredible category. It's something that my world expanded when I learned about it, whether it's the provenance of an item, the rarity, or the traits. I've been a collector of vintage. My partner, Sean Witherspoon, is very well known as a designer, someone who works with vintage. So when he and I connected with our third partner, Brendan Russo from Adidas, we saw this world where people wanted to know more about these vintage items. Vintage is, in 2024 is a $250 billion addressable market. 10% of retail right now is secondhand. Kids right now, they want to wear it, they want to flex it, and they want to learn more about it. And we want to add a chip to it where you tap it and you can learn all about it.
But also you're on the intersection of Web3 as well. I mean, you've got such an interesting career background and history, having been in law, having set up sort of film festivals, having worked very closely and still do with Snoop, for example, who is big in the NFT space.
Yeah.
Why play NFC chips rather than more broadly Web3?
Well, we really started in Web3. We started by thinking about how could these physical items manifest themselves in the digital world. And we did that through thinking about, designers working to design digital NFTs as clothing. How could they work with games like Call of Duty or GTA. So that's where we started. And the more we explored digital, we realized that attaching digital to physical is one of the beautiful things that blockchain offers. So this has just opened up a whole world for us to explore.
And therein lies the underlying technology, the power of it, Devang. But we're now back in a bit of a hype cycle when it comes to crypto, certainly in a hype cycle when it comes to AI. How do you see the wood for the trees? Where are the good investments?
Yeah, I think that's the million-dollar question, right? No pun intended. We look at it from 2 parameters. Of course, when we started ventures, we had a dual mandate. One was potential for returns and looking at where the traditional venture play would look like. But we also try to look at investments we make as potential avenues of bringing new capabilities to Christie's. Can we bring new technologies to Christie's? Similar to what our previous guest was talking about with respect to Toyota. But in our case, out of the 10 investments, 5 of them we've actively used and deployed inside Christie's, which is a very different way of operating. We can actually test these technologies, bring them to customers, give feedback. You saw Nick bring some of his technologies to the Christie's Art Plus Tech Summit last year, which we hope to do again this year. And I think that gives us a real pulse of the technology. Without just deploying capital, we also deploy resources behind it.
Fascinating how your relationship built around that particular event, the Art and Tech Summit. We thank you, Christie's Ventures Global Head Devang Thacker and Mintage founder Nick Adler. Go so fast. Ed, that's it for Bloomberg Technology.
Recap the podcast. Greatest CPI print of our lifetime, some were saying. This is Bloomberg.